As everyone settles into their post-Labor Day routines, it is a good time for investors to reflect on markets and review their financial plans for the rest of the year. August began with the sharpest market declines in 2 years, but major indices rebounded and the S&P 500 finished the month near its all-time high. The Federal Reserve is expected to announce its first rate cut at its September 18th meeting, which has caused interest rates to stabilize in recent weeks. Inflation remains on a downward trajectory and the broader economy appears strong. So while September is beginning with additional market uncertainty, it's important for investors to maintain perspective. Investors should always be prepared for volatility, especially now with possible market-moving events in the coming months. There is still uncertainty around the Fed's full rate cut path, the upcoming presidential election, and ongoing geopolitical risk. What lessons can investors learn from the past few months as they navigate these events and focus on their long-term financial goals? First, despite recent market swings, the S&P 500, NASDAQ, and Dow are up double digits this year. The S&P 500 has experienced only 2 periods of sustained pullbacks this year, with the largest decline measuring at 8%, which is below the historical average. Bonds have struggled much of this year as rates remained high, but the anticipation of Fed rate cuts has helped boost returns more recently. While market volatility is never pleasant, it is important not to overreact to short-term events. As I mentioned, bonds have performed better. Through August 31st, the Bloomberg US Aggregate Index has gained 3.1% year-to-date and 6.7% since its bottom in April when the 10-year Treasury yield peaked around 4.7%. The high-yield bond index has risen 6.3%, the corporate bond index 3.5%, and treasuries 2.6%. Bond prices also jumped at the beginning of August as they helped to balance stock market swings. These facts emphasize the importance of maintaining portfolio diversification, especially during periods of uncertainty. Second, the Fed is expected to begin cutting rates later this month after a rapid rate hike cycle from early 2022 to mid-2023. This is primarily because inflation has continued to improve. The Fed's preferred inflation measure, the Personal Consumption Expenditures Price Index, has decelerated to 2.5% overall and 2.6% when excluding food and energy. Similarly, the headline Consumer Price Index has fallen to only 2.9% year-over-year, with the core index declining to 3.2%. While prices are still much higher for consumers than prior to the pandemic, these improvements are enough for the Fed to justify a shift in monetary policy. Much of the market volatility experienced this year is the result of changing expectations around the Fed. The year began with investors forecasting several rate cuts due to a possible hard landing. Then, when inflation ran hotter than anticipated in the first quarter, investors believed there would be no rate cuts this year. Now, the Fed is expected to cut rates by about 1 percentage point through the end of the year. Each of these turns resulted in shifts in the market. This is yet another reminder that markets can get ahead of themselves, and that it's often better to focus on the underlying trends. In addition, recent jobs data show that the labor market is still strong, but is also softening. The latest employment report, for instance, revealed that 114,000 new jobs were added in July, well short of the 175,000 projected. Unemployment rose from 4.1% to 4.3%. overshooting expectations and reaching a level not seen since the pandemic. Though I'd highlight, still not a historically high number. In a recent speech, Fed Chair Powell discussed the downside risks to the job market, saying, "We do not seek or welcome further cooling in labor market conditions." Whereas the Fed has been primarily focused on bringing down inflation, it is now shifting that focus to the job market. Finally, with Fed rate cuts approaching, market-based interest rates have adjusted as well. As this chart shows, not only have yields moved lower, especially on the short end of the curve, but the yield curve is no longer inverted. The spread between the 10-year and 2-year Treasury yields has flattened in recent days due to the expected trajectory of rates. If these moves continue, they could have several potential implications for the economy and markets. One reason some investors expected a recession in 2024 was precisely because the yield curve experienced its sharpest inversion since the 1980s. Historically, yield curve inversions precede recessions since they typically occur later in the business cycle when the Fed has over-tightened. While a recession is always possible, this time could be different since higher short-term yields were the result of inflation shocks. While nothing is certain, lower rates could be positive for economic growth, especially in rate-sensitive areas such as real estate, technology, and small caps. As discussed earlier, bonds have benefited from improving rates as well, partially restoring their traditional role as portfolio diversifiers. To conclude, how we react to stock market swings is perhaps more important than the market moves themselves. The uncertainty experienced by investors during the summer is a reminder to always stay focused on the long run as you work towards your financial goals.